Now, this is Advanced FM, December 2014. December 2014, question number 4B. It's a question on mergers and acquisition. A good question, comprehensive question. December 2014, question 4B. Let's try checking it out. Mijengo Limited, a company engaged in real estate development, intends to acquire Saruji Limited, a manufacturer of high-quality cement. Mijengo proposes to pay for the acquisition using one of the following three methods. The first one is a cash offer of 10 shillings per share of Saruji Limited. The second one is an offer of 3 of Mijengo Limited shares for 2 of Saruji Limited shares. Of course, the third one, an offer of 2% coupon bond, shillings 100 per value at the same yield to maturity as Mijengo Limited's existing bond, in exchange for 8 Saruji Limited shares. The bond will be redeemed in 3 years at par. The latest financial statements of the two companies are as follows. We have Mijengo and we have Saruji. So revenues, profit before tax, taxation, dividends, retained earnings, net, non-current assets, current assets, share capital, 8,800 for Mijengo and 1,000 for Saruji. Reserves. The current market price is 72 shillings per share of Mijengo Limited, and it is estimated that Saruji Limited's price to earnings ratio is 12.5% higher than Mijengo Limited's current price earnings ratio. So if we can get the price earnings ratio of Mijengo, for Saruji it will be 12.5% higher than that. Mijengo Limited's non-current liabilities include 6% bond, shillings 100 per redeemable in 3 years at par, which is currently trading at 104. The ordinary shares of Mijengo and Saruji Limited have a par value of 0.8. Mijengo estimates that it could achieve synergistic savings of 30% of Saruji Limited's estimated equity value by eliminating duplicated admin functions, selling excess non-current assets, and reducing the workforce if the acquisition was successful. For 14 marks, estimate the percentage gain or loss in Saruji Limited shares under each of the above 3 payment methods. Okay. Now we can start with the gain is all about what is the additional value to ordinary shares after the acquisition. Now, let me use Excel. So if we can start with let's first of all get what is the current value of the shares. So let's have here Mijengo. So tuko hapa na we have there Mijengo, tuko na Mijengo, and we have Saruji. So we can get the profit after tax. So profit after tax, we can see our profit before tax taxation. The blank one is the profit after tax, 9,900 for Mijengo, 1,250 for Saruji. So having 9,900 and 1,250. Let me have this one in thousands. That is our profit after tax. We can get number of shares. Number of ordinary shares for Mijengo. We have the ordinary share capital of 8800, the power value is 0.8. So 8800 divided by 0.8 and 1000 divided by 0.8. So this one equals to 8800 divided by 0.8. And this other side, it was 1000 shares. So 1000 shares divided by 0.8. That is our number of shares. So therefore, we can get the earnings per share, which is the profit after tax divided by number of shares. So this one equals to profit after tax divided by number of shares. That's our earnings per share. And this one equals to profit after tax divided by the number of shares. So we have the earnings per share there. Then we have the market price per share. We were given the market price per share of, was it Mijengo or Saruji? The current market price per share is 7.2 for Mijengo. So therefore, market price per share of Mijengo is 7.2. 7.2. This one is what you are yet to look for. So you can get the PE ratio of Mijengo. PE ratio, which equals to MPS divided by EPS. So equals to market price per share of 7.2 divided by earnings per share of 0.9. So the PE ratio of Saruji, of Mijengo, is 8 times. Then the PE ratio for Saruji, we are told, that the PE ratio of Saruji, it is estimated that the Saruji Limited's price to earnings ratio is 12.5% higher than Mijengo Limited's. So the one for Saruji will be 12.5% higher, that is 112%. So 8 plus 12.5% of 8. So it is simply saying 1.125 times 8. So that is the PE ratio of 9. So for that reason, the market price per share of Saruji would be equals to PE ratio of Saruji times the EPS of Saruji, which equals to PE ratio of 9 times the earnings per share of 1. So that one equals to 9 shillings. So therefore, in answering part 1, we are asking ourselves, how much is our offer price? The offer price is 10 shillings. That's what we are told. An offer price of 10 shillings, cash offer. Then we compare it with the MPS of Saruji, which is shillings 9. So gain is now the difference so our gain becomes 1 shilling. So can we have our percentage gain? So the percentage gain, the new price minus the old price over the old price times 100, or simply 10 minus 1 over 9. So that is 10 minus 1 is 1, divide by 9 times 100. So 1 divided by 9. 1 divided by 9 times 100. So that is percent. So there we go for the first one. That is for the cash offer of 10 shillings per share. Now the method 2, an offer of 3 of Mijengo Limited shares for 2 of Saruji Limited shares. So method 2, so this is about share to share transfer. So we need to get the value of the shares, the value of the firm after the merger. The value of the firm after the merger. Now, in getting the value of the firm after the merger, we have the we need to get the value of Mijengo, then we add to the value of Saruji. Then we shall also have some synergistic savings. When we save, we increase the value. So first things first, we can have it in thousands of shillings. So we have value of Mijengo. Mijengo had 11,000 shares, and each share had a market price of 7.2. So equals to 11,000 times 7.2. Then you also have value of Saruji. Saruji had 1,250 shares, and each share is valued at 9 shillings. So equals to 1,250 times 9. So value of combined firm. So that gives us the total value of the combined firm. Then we also add synergistic savings. Synergistic savings, we are told that Mijengo 30% of Saruji Limited's estimated equity value. So 30% of the value of Saruji. 30% of 11 to 50. So equals to 0.3 times 11 to 50. So now gives us the total value of combined farm. So there we go. Then we have the combined number of shares. The share-to-share exchange, what was the mode of exchange? An offer of 3 of Mijengo Limited shares for every 2. So we are giving out 3 new shares for every 2 out of 1,000 shares that Saruji Limited had. 3 new shares for every 2 out of the 1,000 shares. So this one equals to 3 divided by 2 times 1,000. Then this one we shall add, is on the number of new shares plus zile za Mijengo zitaendelea kukua. Mijengo had how many shares? Mijengo had 11,000 shares. Saruji had 1,250 shares, not 1,000. So this is 1,250. 1,250. So plus 11,000. So this is 1,250. Then we add 11,000. So that is 12 to 50, the combined number of shares. The ones for the predator, Mijengo, and the new shares that will come in, 3 over 2 times 1,250. So therefore, combined market price per share would be equals to combined value of the combined farm divided by combined number of shares. So which equals to 93,825 divided by 12 to 50. So 93,825 divided by 12 to 50. So therefore, we are giving out 3 shares for every 2. So you can have value of 3 shares. Value of 3 new shares, 8 shillings 7.659. So equals to 7.659 times 3. Then we less value of 2 existing shares of Saruji. Each share of Saruji was selling at 9 shillings. So that is 9 times 2. So equals to 9 times 2, which is 18. So you can have the gain. Then, of course, they wanted us to get the percentage gain. So 4.978 divided by 18 times 100. So which equals to this divided by this. We make it a percentage. That's the second part. Then the third method now. Third method. So you're giving out the debentures. Third method, sorry, it was about an offer of 2 coupon bond, 2% coupon bond, shillings 100 per a day. So that is the bond. For how many shares? For 8 shares. So this is about 2 bonds for 8 shares of Saruji. We already know the value of the shares, so we need to know the value of that bond. And you know that the market value for the redeemable bond, the Sabia baby class, was about the interest times the PV FA. We have the KD. I think the bond had a life of, was it 5 years? 3 years. So KD 3 years. Then we add redemption value. Redemption value times the PVIF, KD 3 years. What was the catch in that part B? But the third method is that KD tulinyimwa. Na KD wakatuambia it is at the same cost of capital, is at the same yield to maturity. Yield to maturity of Mijengo. At the yield to maturity, at the same yield to maturity as Mijengo Limited's existing bond. So Mijengo Limited's existing bond iko hapa. We are told that Mijengo Limited's non-current liabilities include 6% bond, shillings 100 per, redeemable in 3 years' time. In 3 years at par, which is currently trading at 104. So the YTM formula is interest plus 1 over n into the market value, the par value minus the market value everything we divide by a half into par value minus plus the market value. Would have adjusted for tax, but tax does not exist in this question. Hakuna mahali tumepewa the tax rate. So our interest 6%, the par value is 100, the market value is 104, life yake ni 3 years. So 6% of 100, face value is 100, or the par value, market value is 104. So 6% times 100 plus 1 divided by 3 into brackets. The par value is 100, the market value is 104. So everything divided by 1 over 2 times 100 plus 104. So we have the so 6% of 100 is 6. So 100 minus of 104 is -4. So -4 divided by 3. Plus 6. Then divide by 0.5 times 204. So that one is 0.0457 times 100, 4.57%. 4.57%. So let's have the market value of that bond. So market value of the bond equals to the interest, the kind of bond that was being issued. I think it was a 2% bond, the par value is 100. So 2% of 100 times PVIFA, 4.57%, 3 years, plus it's always redeemed at par unless told otherwise. We've been told it will be redeemable in 3 years at par. So the par value is 100 times the PVIF, 4.57%, 3 years. So when you apply in this annuity formula, 1 minus 1.0475 raised to power -3, then the answer divided by 0.0475. So this one becomes 2% of that is 2 times 2.7361 plus 100 times, so that other one you're having 1.0475 raised to power negative 3. So 0.8700. Great. So the value of that bond would be times 100 plus 2 times 2.7361, 92. So that is shillings 92.48. Great. So that is the value of one bond. What is the ratio of exchange? We are giving out one bond for every 8 shares of Saruji. So here we less value of 8 shares of Saruji. And each of Saruji, don't forget, was selling at 9 shillings. Each share of Saruji was selling at 9 shillings. As you can see up there, 9 shillings. So we have so that is 9 times 8 is 72. So shillings 72. So you have the gain, which equals to 92.48 divided by 72, minus 72, sorry, minus 72. So this is the gain. Can we get the percentage gain? So equals to 20 divided by 72, and we make it a percentage, 28%. So this is 20.48 divided by 72, new minus old over the old, times 100. So that is it. We have now the question, we've conclusively answered the question, the percentage gain or loss under each of the above 3 payment methods. That is what was expected of us as far as answering that question is concerned. Check on it. Thank you so much. And I wish you well as you continue preparing for your exams. Thank you.